Have you ever watched a freight train grinding to a halt and then suddenly lurch back into motion? That grinding, screeching sound of metal on metal, the screaming protest of inertia being overcome. That's exactly what just happened in the French manufacturing sector. And if you blink, you'll miss the signal that's being sent across the global economy right now. December 2025. France's HCOB flash manufacturing PMI just did something that nobody predicted. It didn't just beat expectations, it shattered them. The number came in at 50.6, up from 47.8 in November. Analysts were expecting 48. They were wrong by a margin that should terrify anyone who's been paying attention to the forecasting models that drive trillions of dollars in capital allocation decisions. But here's what nobody is talking about. This isn't just a number on a chart. This is the first time France's manufacturing sector has crossed into expansion territory, above the critical 50 threshold, since August 2022. Let that sink in. 28 months, more than 2 years of contraction, stagnation, and industrial decay. And then, in 1 month, the machinery roars back to life. The question you should be asking yourself right now is not whether this is good news. The question is, what changed? What invisible hand just reached into the gears of the European industrial complex and flipped the switch? And more importantly, why is the mainstream financial media treating this like just another data point instead of the earthquake it actually represents? Let me walk you through what just happened, what it means, and why the numbers you're seeing on Bloomberg and Reuters are missing the most critical part of the story. When you look at manufacturing data, most people see percentages and indices. They see abstract concepts. But manufacturing isn't abstract. Manufacturing is steel and electricity and human labor. Manufacturing is the physical foundation of everything you touch, wear, drive, and live in. When manufacturing contracts, civilizations weaken. When it expands, empires are built. France has been bleeding manufacturing capacity for years. The country that gave the world Airbus, Michelin, and L'Oreal has watched factory after factory either shut down, relocate to Eastern Europe, or simply stop expanding. The political chaos of 2024 and early 2025 didn't help. President Macron's government collapsed into minority status. Michel Barnier's brief tenure as prime minister ended in a historic no-confidence vote on December 4, 2024, making him the shortest-serving French prime minister in modern history, just 91 days. François Bayrou took over in mid-December 2024, inheriting a fractured National Assembly and a nation teetering on the edge of fiscal crisis. And yet, somehow, in the middle of this political maelstrom, French factories started hiring again. The employment index in the manufacturing sector reversed November's decline and moved into positive territory. Companies that were laying off workers in October and November suddenly started posting job openings in December. This isn't seasonal adjustment. This isn't statistical noise. This is a behavioral shift. The production index tells an even stranger story. It climbed to 49.7 in December from 45 in November. That's a gain of 4.7 points in 1 month. To put that in perspective, manufacturing output indices typically move in increments of 0.5 to 1.5 points per month. A 4.7-point jump is the kind of movement you see after a war ends or a major trade deal is signed. Except there was no trade deal. There was no peace treaty. There was just December 2025. What we're witnessing is what engineers call a phase transition. Water doesn't gradually become ice. It stays liquid, 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 and then suddenly it's solid. The French manufacturing sector just froze into a new state, or melted into one, depending on how you look at it. Here's where it gets really interesting. New orders increased in December, and the report specifically mentions a lift in foreign demand. Foreign demand. For French-manufactured goods, in December 2025. Let's put this in context. The Eurozone has been a graveyard for manufacturing growth. Germany, the industrial heart of Europe, has been in technical recession for most of 2024 and 2025. The German manufacturing PMI has been below 50 for 28 consecutive months as of December 2025, mirroring France's previous pain. Italy's manufacturing sector has been contracting. Spain has been the only bright spot, and even that's been flickering. So who exactly is buying French manufactured goods? The report doesn't say. S&P Global, which compiles the PMI data from surveys of purchasing managers, doesn't break down the geographic source of the foreign orders. But we can make some educated guesses based on what we know about global trade flows in late 2025. China has been on a buying spree for European industrial goods since October 2025, particularly in the aerospace and luxury manufacturing sectors. The Chinese government announced a 3 trillion yuan stimulus package in late September 2025, focused on consumption rather than infrastructure for the first time in decades. French luxury manufacturers and aerospace suppliers are direct beneficiaries of this shift. Airbus, which assembles aircraft in Toulouse, has been ramping up production to meet backlog orders that have been delayed since the pandemic. But there's another player nobody is talking about: India. India's manufacturing boom in 2025 has created enormous demand for high-precision industrial equipment, pharmaceutical manufacturing components, and automotive parts, all sectors where French companies maintain competitive advantages. The India-Middle East-Europe Economic Corridor, announced at the G20 summit in New Delhi in September 2023 and making its first operational impacts in 2025, has reduced shipping times and costs between South Asia and Mediterranean Europe. French exporters are suddenly more competitive in the Indian market than they've been in 20 years. And then there's the defense angle. European defense spending has exploded since 2022, but the procurement cycles finally started converting into actual orders in 2025. France's defense industrial base, Thales, Dassault Aviation, Naval Group, has been hiring and expanding capacity throughout 2025. The war in Ukraine is now in its 4th year, and European NATO members are finally, belatedly, building the stockpiles and production capacity they should have maintained all along. French factories are producing ammunition, electronics, and weapon systems at rates not seen since the Cold War. So the foreign demand isn't a mystery if you've been watching the undercurrents. What's mysterious is why it all hit in December 2025. Why not August? Why not October? What synchronized the purchasing decisions of Chinese consumers, Indian manufacturers, and European defense ministries to all land in the same 4-week window? Now we get to the part that should make every economist in the world stop and scratch their heads. Input cost pressures eased in December. At the same time, factory gate prices, the prices manufacturers charge for their finished goods, rose at the fastest pace in 16 months. Read that again. Costs went down. Prices went up. Profit margins just exploded. This violates the basic supply and demand logic that's been drilled into every business school graduate since Adam Smith. When your input costs fall, competitive pressure should force you to lower your prices to gain market share. When your input costs rise, you raise prices to protect margins. But when costs fall and prices rise simultaneously, something else is happening. Something that has nothing to do with costs and everything to do with market power. What changed in December 2025 is negotiating leverage. French manufacturers, for the first time in years, have buyers who are desperate. The foreign orders we talked about aren't casual purchases, they're critical procurements. When a Chinese consumer finally decides to buy that luxury handbag, they're not price sensitive, they've been saving for months. When an Indian automotive manufacturer needs a specific sensor component, they can't substitute it with a cheaper Chinese knockoff because quality standards matter. When a European defense ministry needs artillery shells, they'll pay whatever the price is because the alternative is losing a war. French manufacturers smelled blood in the water. They realized their customers had no leverage, so they raised prices. Not because they had to, because they could. The input cost decline is equally fascinating. Energy prices in Europe have stabilized in late 2025 after the volatility of 2022 through 2024. Natural gas prices on the Dutch TTF benchmark, the European reference point, have been trading in a relatively calm range between 35 and 45 euros per megawatt hour in Q4 2025, down from the insane spikes of 300 plus euros in 2022. This has taken enormous pressure off energy-intensive manufacturing processes. But there's something else. Raw material costs have been deflating globally. Copper prices dropped 18% from their April 2025 peaks to December 2025. Aluminum is down 12% in the same period. Steel prices in Europe have been in steady decline since mid-2024. This isn't because demand is weak. It's because supply chains have finally healed from the pandemic disruptions and the commodity supercycle that followed has broken. So French manufacturers are paying less for energy and raw materials while charging more for finished goods. If you're a shareholder in a French industrial company, you just had the best quarter since the pre-pandemic era. If you're a buyer of French manufactured goods, you just got squeezed. The employment component of the PMI reversed from contraction to expansion in December. Manufacturing firms that were cutting jobs in November started hiring in December. This is the canary in the coal mine, or the phoenix in the ashes, depending on your perspective. Hiring is a forward-looking decision. You don't hire workers because business was good last month. You hire workers because you believe business will be good for the next 6 to 12 months. Firing is reactive. Hiring is predictive. When French manufacturers started posting job openings in December 2025, they were making a bet on 2026. But here's the uncomfortable question. Are they hiring because they're confident or because they're desperate? The report mentions that backlogs of work fell at a slower pace in December. Backlogs are unfinished orders sitting in the queue. When backlogs decline, it means companies are catching up with demand, or demand is weakening. The fact that backlogs are still falling, just more slowly, suggests French manufacturers aren't overwhelmed with orders. They're managing them. So why hire if you're not overwhelmed? Two possibilities. First, companies are preparing for a surge they expect in Q1 2026. Second, they're hiring now because labor markets are softening and good workers are available. France's unemployment rate in November 2025 stood at 7.4%, up from 7.1% at the start of the year. It's not a crisis, but it's a trend. If you're a factory manager and you've been struggling to find skilled workers for 3 years, and suddenly those workers are available, you hire them now before the window closes. There's also a third possibility that nobody wants to talk about: government incentives. The Bayrou government, desperate to show economic progress before the next round of political chaos, may have quietly offered tax breaks or subsidies for manufacturing employment. The French state has a long history of industrial policy, dirigisme they call it, and 2025 has been a year of renewed state intervention across Europe. If the government is subsidizing hiring, companies will hire. Whether those jobs are sustainable is a different question. And now we arrive at the most important sentence in the entire PMI report, the one that gets buried in the footnotes. Despite these improvements, business sentiment remained cautious amid ongoing political uncertainty and subdued consumer demand, keeping confidence below historical averages. Read that carefully. Despite everything we just discussed, the return to expansion, the foreign demand, the employment growth, the pricing power, business sentiment remained cautious. Confidence stayed below historical averages. The people running French factories, the purchasing managers and operations directors who actually answered the PMI survey, are not celebrating. They're not popping champagne. They're nervous. Why?
Because they can see what the aggregate numbers hide.
The political situation in France is a slow-motion car crash. François Bayrou's government has no parliamentary majority. Every piece of legislation is a negotiation with multiple factions. The far-right National Rally, led by Marine Le Pen and Jordan Bardella, controls the largest single bloc in the National Assembly. The left-wing coalition, the New Popular Front, controls the second-largest bloc. Bayrou's centrist coalition is trapped in the middle, trying to pass budgets and reforms without triggering another no-confidence vote. This political paralysis has real economic consequences. France's budget deficit for 2025 is projected to hit 6.1% of GDP, far above the EU's 3% limit. The European Commission has initiated excessive deficit procedures against France, threatening potential sanctions. French government borrowing costs have been creeping upward. The spread between French and German 10-year government bonds, a key indicator of financial stress, widened to over 80 basis points in late 2025, the highest since the European debt crisis of 2012. French CEOs and factory managers read the same news everyone else does. They see the political instability. They see the fiscal crisis brewing. They see consumer confidence in France stuck at depressed levels. The INSEE Consumer Confidence Index has been below its long-term average for all of 2025. And they're thinking, this manufacturing recovery might be a temporary blip, a lucky confluence of foreign demand and falling costs that won't last into 2026. The subdued consumer demand mentioned in the report is particularly damaging because it reveals the domestic market remains weak. French consumers aren't spending. Retail sales growth has been anemic throughout 2025. The savings rate has been elevated, as households, worried about the political and economic outlook, are hoarding cash rather than buying new cars, appliances, or furniture. If you're a French manufacturer dependent on domestic demand, you're still suffering. The December boom is all about exports, and exports can reverse quickly if the global economy hiccups. The PMI report states this is the highest reading since August 2022. Let's revisit August 2022 for a moment, because context matters. August 2022 was the month before Europe's energy crisis went into full panic mode. Natural gas prices were rising, but hadn't yet hit their catastrophic peaks. The war in Ukraine was 6 months old. European manufacturers were still operating under the assumption that energy supplies would normalize by winter. They were wrong. By December 2022, factories across France and Germany were shutting down or curtailing production because they literally couldn't afford to keep the lights on. The August 2022 PMI reading of 50.6 was a false signal. It looked like French manufacturing was holding steady. In reality, it was the last moment of normalcy before the storm. Within 3 months, the sector had collapsed into deep contraction. Is December 2025 another false signal? Are we about to see another energy shock, another geopolitical crisis, another economic collapse that makes this month's optimism look foolish in hindsight? The purchasing managers who answered the survey certainly seem to think it's possible. That's why sentiment remains cautious. Or maybe the parallel to August 2022 is misleading. Maybe this time is different. Maybe the phase transition is real. Maybe French manufacturing has found a new equilibrium, supported by defense spending, Asian demand, and recovered supply chains. Maybe the next 28 months will be expansion, not contraction. The data can't tell us which scenario is correct. The numbers are backward-looking. They tell us what happened in early December 2025 when the surveys were conducted. They can't predict January 2026, let alone the rest of the year. Here's what you need to understand about PMI data. It measures change, not levels. A PMI of 50.6 means manufacturing activity expanded slightly compared to the previous month. It doesn't tell you whether the absolute level of manufacturing output is high or low, compared to historical standards. France's industrial production in 2025 has been recovering from extremely depressed levels. Even with December's expansion, total manufacturing output in France for 2025 will likely be below 2019 levels. The country has lost industrial capacity permanently. Factories that closed in 2022 and 2023 haven't reopened. Workers who were laid off have moved to other sectors or retired. The manufacturing base has shrunk. So, yes, activity expanded in December, but it expanded from a low base. It's like a patient who was in critical condition improving to stable condition. They're still in the hospital, they're still sick, they're just not dying anymore.
The PMI also doesn't capture structural changes in what's being manufactured.
France has been hollowing out its mid-tier manufacturing, the bread-and-butter industrial goods that employed hundreds of thousands of workers. What remains is increasingly concentrated in high-value sectors: aerospace, luxury goods, pharmaceuticals, defense. These sectors can generate impressive PMI numbers with relatively few workers. They can drive exports and profits, but they don't employ the masses. They don't rebuild the industrial middle class. This is the uncomfortable truth hiding inside the December PMI celebration. French manufacturing might be expanding, but it's expanding in a way that benefits shareholders and executives more than workers. The employment increase is real, but it's concentrated in specialized, high-skill positions. If you're a laid-off auto worker from a closed Renault plant, the fact that Dassault Aviation is hiring aerospace engineers doesn't help you. So what does December 2025 actually tell us? Strip away the noise, the political commentary, the speculation about foreign demand sources. What's the signal? The signal is this. For 1 month, the negative feedback loops that have been crushing European manufacturing broke. Energy stayed cheap. Foreign buyers showed up. Costs fell while prices rose. Companies felt confident enough to hire. The machinery that had been grinding to a halt lurched back into motion. Whether that motion continues depends on factors far outside the control of French factory managers. It depends on whether China's stimulus actually boosts consumption or just inflates another property bubble. It depends on whether India's growth remains strong or hits infrastructure bottlenecks. It depends on whether European defense spending continues to accelerate or gets cut in budget negotiations. It depends on whether the global economy slides into recession in 2026 or continues its fragile expansion. Most importantly, it depends on politics. If France can achieve some measure of political stability in 2026, if Bayrou or his successor can cobble together a functioning government, if the National Assembly can pass budgets without monthly crises, then business confidence might recover. And when confidence recovers, investment follows. And when investment follows, sustainable expansion becomes possible.
But if the political chaos continues, if France faces another government collapse, if the fiscal crisis escalates into a bond market panic, then December 2025 will be remembered as a brief false dawn. Another August 2022, another moment of hope before the storm. The manufacturing sector has given us 1 month of good news. Whether it's the start of a new chapter or the final page of an old one, we won't know until we've turned several more pages. The machine blinked. It showed signs of life. But a blink is not the same as waking up. If you found this analysis valuable, subscribe to stay ahead of the economic signals that mainstream media misses. Leave a comment below with your thoughts on where French and European manufacturing heads in 2026. What are we missing? What signals should we be watching? The conversation continues in the comments.